the Obama administration's recent proposal to stop guaranteeing FFEL loans, make the loans directly, and redirect taxpayer savings into a mandatory Pell Grant program. As everyone in this room knows, this proposal has proved very controversial.
We are proposing, since we are taking the risk, we provide the funds, borrow the funds from the same people who would lend the money for the bonds that would have gone to lenders in secondary markets in the student loan program. You can think of it over time as we borrow the money, students repay, and in a sense it creates a revolving fund where only the subsidy needs to come from either taxpayers or from borrowing from the capital markets. Because we are receiving the student repayments, that helps to overall cover our costs, and all of this together, these reforms, not only reduce the deficit, but lowers the federal debt over time because it costs us less to subsidize the overall system. We use those savings to plow into the Pell Grant program, to make the Pell Grant program an entitlement so that not only do we avoid the potential drop in Pell Grants in a couple of years by $1,000 to $1,200, but we propose an actual increase in Pell Grants that would keep pace with Consumer Price Index plus 1%.
If you were to eliminate FFEL, you do actually have a net negative effect. One of the first things that goes is the philanthropic activities. You don't see college access programs being supported. You don't see the financial aid nights, those types of things. There's scholarships and debt forgiveness programs, interest rate reductions. All of that disappears. In some cases, making the loans more expensive for borrowers, but in many cases, making the process much more difficult for borrowers to understand. You can argue, and I think many will, that the government can take over those responsibilities. But that doesn't come free. It's not without a cost. The government, if it's going to replace those activities, it has to pay for it somehow. Also, you're eliminating choice. The borrower has no... When I attended school and I borrowed from the neighborhood community credit union, where my parents had banked for 30 years, that was a choice that I was able to make. Under a 100% direct lending scenario, that's not an option any longer. Maybe that's a good thing or not a good thing, but in my view, and I think the view of many, it is a good thing to have consumer choice among lenders.
As a public purpose entity, we needed to focus on what is our role as a not-for-profit, as a public purpose entity. And as a public purpose entity, we should be doing something that the government should do, but can't do effectively from a perspective, and that the private sector can't do. And the one thing that the guarantors, that this public purpose can do is the debt management side of it. It is a public purpose initiative that provides the services to the borrower over the life of the loan that they need in a proactive way.
What people are talking about, what Scott's talking about when we say that the lenders provide borrower benefits, is that they provide a little bit more, a little bit better terms than what's set in law. What lenders are doing is they're saying, well, you know what, the subsidy I'm getting from the federal government is generous enough that I can pass a little bit more of that on to the student in form of better benefits. So the most common one is that a few years ago was that borrowers would give students or lenders would give students a 1 percentage point interest rate reduction for on-time repayment. That was the most common one. But you don't need to preserve high subsidies for lenders in the hopes that they'll pass these benefits on to borrowers. Remember, all the terms in the loan are set in statute. So Congress, if the borrower benefits are so important to members of Congress, and you'll hear them on the Senate floor and on the House floor saying we need to preserve the borrower benefits, they can write them into law. If they want a 5.8% interest rate for all students, they can write that into law and all students will get it.
I don't think the nationalization argument works that well for the lenders, just because it has been using government capital. The true nationalization, and Bob alluded to this, would be if the government were to take over every aspect of the lending programs, administer it themselves, service it themselves, hire 10,000 new federal government employees to handle the servicing and not go through federal contracting. So Yeah, you do actually end up pushing about 2,000. Jason made this point. You push out 2,000 private lenders by going to 100% direct lending. It's not true nationalization, but there is an impact there.
From a conservative point of view, if 1,000 lenders go out of business who are running a government program, but everyone still gets the loan at the end of the day, all the students still get the loan, well, that's good. We've gained efficiency. We have fewer people running a program that delivers the same benefits to everyone. And yeah, those people have lost their jobs, but maybe they will find jobs that are perhaps more productive, more necessary, or generate a higher return for themselves and for taxpayers and for the economy as a whole. But if this is an argument about jobs and we want the program to preserve jobs and create jobs, well then triple the subsidy to lenders, quadruple it. They'll get more money and they'll hire more people. We'll have more sales forces. We'll have more advertising, and we'll create more jobs. Now, I don't know if that's really the best use of our resources, but if you do want to create more jobs, that's how you could do it through the program.
The department has been preparing for 100% federal loans even before this administration. The previous administration began, and part of this is because of the ECASLA, the emergency program that was set up to keep the FFEL origination occurring. Many of those loans, perhaps most of those loans, will be purchased by the federal government, and the federal government will be contracting with private sector servicers to collect on those loans. And so whether it is FFEL loans purchased by the federal government or direct loans made by the federal government, we are preparing to have full servicing capacity for all of those loans. So that will not depend on, having that capacity doesn't depend on whether Congress acts or not, because the lenders have the right to sell all of their loans to us. So we have to be prepared with the private sector servicers who can handle that full capacity.